Well, welcome to this presentation by Chifley Securities. This presentation is on alternative finance for developers and investors, pretty much private finance for construction finance and for commercial finance. So I guess maybe 5 years ago, there was about 25 professional private lenders around the traps. And in my last count, there was about 230, and I'm sure I don't have a list of all of them. So there's been a huge boom of private lenders on the back of the perception that banks are not lending as much as they used to, which is probably a correct perception. So let's look at really where things fit. I like things in order. So the first thing I look at is the traditional forms of finance, and that's the first tier, which we all know of. So the CommBank, ANZ, NAB, and Westpac. And then, of course, the second tier is about 120 banks, Delphi Bank, Macquarie Bank, Me Bank, lots of other banks in there. Now, a lot of times, the second tier banks are owned by the first tier banks. Not always, though, but definitely both first and second tier are fully regulated by APRA. The last tier, the third tier, is where basically we fit in. So, the third tier, is a whole bunch of private financiers, but also called private finance, private banking, non-bank finance is a common term, non-bank lending, and the new term that's come out of the States is shadow banking, which is different to shady banking, which is subject of a different lecture. Today, we'll just call it private finance and make life a bit easier for all of us. So, my name's Dominic Lambrinos. I'm a partner here at Chifley Securities and one of the founding partners. So I started life as a chartered accountant and I was a partner in the firm of chartered accountants. I left that for finance. And during 32 years of doing this, I've written a few $1 billion of deals and written courses for brokers and developed financial products which are being used throughout Australia today. So hopefully I've got some credentials to talk about private finance. So, good idea to understand is where do private finance get its money from? So mum and dad's deposits, so they're sort of normally derived through prospectuses and they paid a return just like money in a bank account. They're the ones which one has to be careful of the most if you're financing through a private organisation with prospectuses. They tend to, they have in the past been the first ones to fall off the perch in bad times. For example, a company called Banksia. We also get our money from rich people, also known as high net worth individuals, and superannuation funds or institutional money, international investment groups. So that's money from family offices from overseas, not just Australia, but we get a lot from Singapore at Chifley. Private equity firms, some out of the UK, but mostly out of New York and the US. Overseas REITs, and that stands for Real Estate Investment Trusts, and obviously when they have surplus funds, they give us money to invest in the property market, and money markets, asset management, and governments. Now, there's not much money that comes out of the government for this, mind you, but projects which are basically, say, green or have a social conscience can be seen to be supported by government finance. So basically anyone who gives us money. Chifley, think of us as a hotel with many rooms. Some rooms are large for large investors, some are small, and some are closets for smallest investors. So when a transaction comes in, we try to put the transaction in the right room so it gets financed as quickly and easily as possible and for the right price. So why use private finance? So private finance does the deals that APRA tells a bank not to do. Because borrowers don't comply with banks, I guess. They don't have tax returns, or they've got a tax arrangement, or they don't have enough pre-sales, for lots of reasons. They don't tick all the boxes, in other words. Because a loan needs to be done quickly, generally you'll find that private finance can do a deal much quicker. So in commercial terms, we can do a transaction in 2 to 3 weeks. That's a normal transaction. Or we can do a construction transaction in about 4 to 6 weeks, 5 weeks average. So in addition to that, some people don't want to comply with all the bank's requirements. They just can't be bothered, and they just rather go to private because they know it's an easier road and they're happy to pay the extra costs associated with that. And because also banks may have stopped funding a certain class of asset, that could be it could be private hospitals, it could be childcare centres, it could be nursing homes, who knows? But they change over time. Or hotels. That's happened a bit lately as well. Private finance versus banks. Now, we manage risk differently to banks. So where a bank has the fee is set and manages the transaction by risk. So if it feels like the market is getting too risky, it will ask its customers to provide, say, more conditions like more pre-sales. Or if it thinks it's still risky, it'll ask them to lower the LVR and put in more equity. So that creates a buffer around the bank. Private finance is different. We actually accept the risk as it is and move the pricing. So it's a real true risk-reward model. High risk does not obviously mean no. So we're a bank, you've got the 10 boxes to tick, and if you tick 8 of those, you can't get your loan. But with us, it's like a dial on a radio. Remember those old radios? So you can actually dial, if you tick 8 and 9 boxes, you're at the low end, low volume. But if you only tick 1 or 2, you're at the higher volume. And that volume represents pricing. Rates are dictated by supply and demand as well, not just risk reward. So if there's a lot of people in a certain category of finance, say in $5 million or under, then the demand for money is less than the supply of money, and therefore price comes down. Sometimes the model does extend to risk, reward, and opportunity. So we had recently a particular client who had a loan with a bank, and just before settlement, the bank changed their mind and decided not to continue with the transaction. And this particular borrower was at their wit's end. So they came to see us, and we were able to provide a solution in one of those rooms where we could give them $20 million in 24 hours and sell the transaction, get their ducks in a row. And yes, it is expensive, but it's only for a short period of time. So in that month or two, they got their ducks in a row, and they were able to transfer the loan to a more normal facility with Chifley Securities. So that's what we're able to provide. Look, it's easier for the approval process, so the actual due diligence is not as arduous. We have a different credit process. We do look more at the asset. We emphasise the asset as distinct to the sponsor. A quicker settlement time, we've discussed that. More flexible with amending terms. So I'm not too sure. Last time we went to a major bank and asked them to change their commercial mortgage contracts. So probably that's never happened, not that I know of. But we will consider your requests. Your access to decision makers, hi, that's me, and it's us. There's about 3 of us in our firm that do that. We have a more entrepreneurial approach, so therefore you go to a transaction which is outside the norm, we'll look at it. If it's a good transaction, we're more likely to bank it. And of course, we don't have tax returns or financial statements or requirements for tax portals. So that shows you we're a little bit different. Now, private financiers are at their core asset lenders. So we'll lend on commercial property, we'll lend on land banks, specialised assets like I discussed, could be private hospitals, nursing homes, could be childcare centres, or medical centres for a matter, or hotels. Residential, non-NCCP though, non-coded residential. So usually those residences are held in the company, and normally we do the ones which are much larger, the $20, $30 million homes. We'll consider every capital city. Now, whilst we say that, you'll find that there's areas of Melbourne and Bendigo, and going up to Sydney, and then north of Sydney up to Port Macquarie, Newcastle, and then to the Central Coast, and all the way down to Wollongong, quite easy, going up to Surfers Paradise and that corridor through to Brisbane. But when you start getting outside those major areas, and we will do also Adelaide and Perth, but when you start getting outside those areas, it gets a bit more difficult, and you'll find private lenders don't lend well in rural scenarios either. We'll do up to 80% LVR, so we can do it as a stretched mortgage. Our usual LVR is 65%. interest is normally capitalised in the loan. So we don't really look at serviceability because we know the interest has been paid for the period of the facility upfront. So rates and fees, they can change, they vary all the time, so feel free to give us a call anytime to discuss the most recent fees and hate to say this, but specials or opportunities which come by, and they do come by quite often. So in New South Wales you can get a loan from as low as 7.95%. In Queensland, Victoria, about probably 9.95, and that can be as low as 7.95 as well for low pre-sales and no pre-sales. And those loans are those rates are pretty well clear all the way up to about 35 million. Commercial finance, they're about between 9.95 for a particularly good asset. They can go all the way down to 6.95. Now we haven't written that rate there because it becomes more of a it's not really the norm. So 8.95, but 9.95 to 11.95 is the norm, and that takes us all the way to 35 million. And land banking is about 50% to 65% of VR, depending on its location. And again, that 9.95% is the average price. All right, I hope I've helped you today, and sort of got to suggest a few different things with private finance, and we hope to hear from you. If you have any questions, please don't hesitate to contact any of our BDMs or myself. Thank you very much for your time.